Hi there, this is the thing about SMCI, Super Microcomputer. Right now the market cap, if you check it, is about $25 billion. This is important because you have to value this company. If you want to make a profit, you have to know the value of this company and then to assess if it's undervalued or overvalued. Then the price, $43 per share, right? Now let's look at their balance sheet, what they have. 2.5 billion in cash, good. Debt quite low, barely 100 million, and net cash position $2.4 billion. Compare this amount with the market cap, you can see that it's a big difference. The market cap is much higher, 10 times higher than the net cash position. So the value of this company, SMCI, doesn't lie on their balance sheet, but where? On their revenue and profits, and of course their future growth rate. If you look at the revenue over the last 3 years, and also the expectations, what the market expects, you can see that in 2022, the revenue was about $5.2 billion, right? Then a nice growth rate from 2022 to 23 here to 7.1 billion. Then the revenue doubled in 2024 from 7 billion to close to 15 billion. And more recently, if you look at the outlook, the guidance from the company, again they expect another great growth rate from 15 billion to $22 billion. But why the stock price have declined from its highest peak? Because if you look at the stock price, it's something like this. Went up, down, and a little bit up. From its highest peak, the stock price went down. Well, that happened because if you look at their earnings, here, 2022, close to 300 million in earnings, right? 5% margins. 2023, 600 million, an increase in their earnings, nice. Margins have increased, 8.4%. 2024, 1.1 billion, so almost a double in their earnings, that's great. Margins, 7.7%, so a decrease in their margins. Then 2025, if you look at their guidance, and also look at the market expectations, the earnings are expected to decrease a little in 2025, despite the growth in the revenue, to 1 billion, about 1 billion. They might make 1 billion. Of course, it depends on many things. And if you look at their margins, 4.5%, if they deliver 1 billion. What does it mean? This means that their margins have contracted from 8% to 4.55%. And this is likely. This is likely to continue. Their margins to be about, around 5%, depends on the year. 4, 5, 6, something like that, around that level. So, if you assume that the margins continue to be about 5%, then you have to understand that the value of this company may be a double from this level if they continue to grow their revenue, or this is the fair value, 25 billion. So let me explain. Over the next 5 years, the revenue, the market expects the revenue to double, to reach a level about 50 billion, right? Now, if the margins will be around 5%, that means they will make about 2.5 billion in earnings, right? And here is the thing. If they make 2.5 billion in earnings, let's say maybe 3 billion if they increase those margins, if they succeed to add more services. Let's say 2.5 billion, right, in earnings. If they make 2.5 billion in earnings, and the growth rate in their revenue continues by 5% and also earnings per year, then you can have a double from this level. in the next 5 years from SMCI. This is the upside that I see, the reward. Of course, maybe a double and a half, maybe earnings, maybe about 3 billion. That can also happen. So the market cap can go to 60 billion. That can also happen, especially if they announce other big contracts. The market cap may become more than a double, 2.5 or something like that. Now, here is the trick. Here's the trick, and you have to understand. If their margins keep declining, especially if they go to 2.5%, or if they don't deliver 2.5 billion earnings, especially if the growth rate doesn't go up as the market expects, is lower, then you might have big surprises. At the end, after the 5 years, the market cap may be about the same, $25 billion. And your investment will deliver a flat, zero return. So you have to be very careful about this company, about your money especially. Now, to assess the future growth rate of this company, you have to look at what they sell, what they do. If you look, they have two segments: server and storage systems, and subsystems and accessories. Most of the revenue comes from this part, server and storage systems. Because as you know, there is a high demand. So high demand for their products to build data centers, right? Now, in my view, for the next 3 years, of course, the revenue can double, may reach this level, 50 billion in revenue. Or maybe might be lower, 40 billion or higher, but around this range, 50 billion. And that's great. And their profits may reach 2-3 billion. Now, here is the thing. If this growth rate after 5 years, after they reach 50 billion, this growth rate doesn't continue to go high, 5% a year, if this growth rate doesn't continue, then that would be bad, because you no longer have a multiple about 20 on their earnings, about 10 or 14. It also depends on what they sell. They may come up with other services, other products. So here is about their future growth rate. As I said, you can have a double from this level, flat, or a small increase. And you have to be very, very careful. Because right now, let's say the worst case scenario, you have a flat, right? A flat growth rate after they reach 50 billion, right? And if that happens, from this level, you can't expect more than 25 billion. If they deliver more than expected, they continue to grow, then yes, you can expect a double, 2x. But if the growth rate becomes flat, more than 25 billion you can get from this company. You have to understand this. I'm not here to tell you that your investment won't do great, but to make you aware of the risk, right? So the risk, if you wait for the next 5 years, may be zero. The risk of losing money. Of course, in the short term, the market cap can decline from 25 billion to 15 billion. Around that range. Now, if they continue to grow, they come up with other services, especially for monitoring those systems, or other products, then the growth rate can continue. And you can have a double, or more than that, 2.5. You can have, as I said, 2x. That's the upside. But you can't expect, what I want to say, you can't expect the same growth rate as it happened in the last 3 years. to see a jump in the stock price over 3-4x. No, you no longer can have that great performance. You have to be aware of that. You may have from this level a double, the good scenario, the best case scenario, a double and a half or something like that. That's the best scenario. Now, if the growth rate goes down, the margins contract, they may go to 2.5%, then that will be quite bad for you. Over the next years, 5 years to 10 years, your return might be about zero. Because the market cap, yes, it will go down the short term, and then it will rebound back to 25 billion, maybe. And also, if you look at the revenue for the last quarter, especially the growth rate quarter over quarter, was a decline. So you have to be very, very careful how do you want to invest in this company. As I said, if everything goes well, and is likely, they have good tailwinds from data centers because there is demand, you can have a double from SMCI in the next 5 to 10 years. But, as I said, be very careful because also the worst case scenario can happen, where the multiple may get lower due to lower growth rate. And that happens in the next 5-10 years, your return might be zero. So be very careful about this investment and don't think that you can have a 10x over the next 5 to 10 years. Over the next 5 to 10 years. You can no longer achieve this performance. Be aware of this. Now, if you want better investment ideas, can deliver you more than a double, you can join my membership, where you can have access to my portfolio. And more recently, I bought an undervalued company that can deliver you better returns than SMCI. And by the way, that company is from the US. So if you want to increase your returns, join my membership. And that's it for this video. And if you have other questions, please let me know in the comments.